Welcome, ladies and gentlemen. My name is Dustin Kircher. I got my partner here, Ben Dreiser. We are with MHP Nation. Today, we have an awesome guest, Matthew Ricciardella. He's got 20 plus years in real estate. He's been a principal in 1 billion in assets and currently has over 500 million of assets under management. They focus on underperforming mobile home parks and self-storage. So we're happy to bring Matthew on the show and talk about his experience and dive deep into what he's doing. So Matthew, thank you very much for coming on the show today.
Yeah, absolutely. My pleasure. Thanks for having me, Dustin. Ben, it's great to be here with you.
Yeah, thank you for taking the time. I mean, 500 million under management. You must be a very busy person. So, uh, it's,
Yeah,
that's
it's all about structuring a great team.
yeah,
If you got a great team to manage these assets and to scale up, it does become easier with size. It doesn't become harder. So to go from, not to jump right into it, but to go from one park to two parks is, in my opinion, a lot harder than going from 40 parks to 50 parks.
yeah, nice. So, I mean, you bring up a good point. You obviously you got the team that helps running the day to day and stuff. So, was that team? We'll jump right into it. What does that team look like for you guys?
Yeah, so basically what we've done is, first off, our main company is Crystalview Capital, which is a private equity company. We raise equity capital for the most part from high net worth individuals, family offices, fund of funds. And what we're doing is we're going out and we're deploying that capital, as you mentioned earlier, into underperforming or non-performing self-storage and manufactured housing properties throughout the U.S. But the way we're managing the assets once we acquire them is we have a third-party property management company called Osprey Management. It's an affiliate entity that I own.
Okay.
And basically what we're doing is we're hiring folks both at the corporate level and then at the on-site level in the field throughout the country. We're in 27 different states.
Mm.
And, we've developed proprietary systems and data, information that basically allows us to scale and to scale effectively and profitably. So that's kind of the support team behind what we're doing, which is really allowing us to deliver some pretty nice returns to our investors.
Nice. Yeah. So, with your management side of that, I mean, what is it that you would say is like the number one thing that you guys are looking at when you're purchasing these underperforming assets that you're going to be able to jump in there and improve them?
Yeah, each property is a little bit different. I wouldn't, I've been doing this for, like you said, about 20 years now, and I can't say that two parks are exactly alike. They're certainly
Mm-hmm.
nuanced. In some cases, it's merely the rents are way below market value, and we want to come into the park and do something in exchange for a rent increase, whether that be new roads, clubhouse, making improvements across the community. Sometimes it's vacant sites. In a lot of the communities that we buy, there's vacant, sites with a pad on them. And what we're doing is our team, back to Osprey Management, our team is basically putting a plan in place to go and buy homes, whether they be brand new homes or pre-owned homes, bring them onto those vacant sites, set them up, and then we're either doing a rent to own or an outright sale to sell that home and to increase that occupancy. Because as we increase occupancies, distributions go up to our investors and the value of that underlying asset is going to rise.
Nice.
Amazing. Can you rewind back and say how you actually got into real estate and mobile home park, self-storage,
Yeah.
and how that kind of journey evolved to where you are 500 million under management, which is incredible.
Yeah, thank you. I appreciate that. In fact, we're probably closer to 600 today, and we've got a really robust pipeline. We're actively raising capital in our fourth fund, which is a $200 million offering.
Wow.
And we've got probably about 100 million in assets, the majority of which are MH in our pipeline that we're going to be closing on within the next 2 weeks to 120 days. So we're really excited about the scale that we're bringing on here.
Yeah.
And I would anticipate, in the next year, maybe 18 months, we're going to be at about $1 billion in AUM. So we're excited
Nice.
about that. But to answer your question, Ben, rewinding back 20 years ago, it's kind of an interesting story. was a residential realtor when I got my start. And the way I built my business up is through cold calling and direct sales. And that process worked well for me. And then I wanted to make this transition away from being a agent to being an actual owner. So I started flipping houses in Southern California. This is back in, 03, 04, around that time. And from there, I really wanted to own assets that generated cash flow rather than flipping a house, having to start back over, which is great. But I really wanted that generational wealth that produces that free cash flow month in and month out, kind of regardless of what you do, that you could grow if you know what you're doing.
Mm-hmm.
So I dabbled in all property types. I was in office, retail, multifamily. And what happened is I kind of noticed I was looking for the best cash flow. And what I noticed is these two property types continued to stand out to me that generated the highest cash flow. One was storage and one was manufactured housing communities. So I started buying them, learning about them. At that time, it was very much a mom and pop industry. Today, a lot of institutional capital has come in. There's a lot of debt providers with Fannie and Freddie, the CMBS market on storage. When I started, it was you find a seller who's going to finance the deal, or you really couldn't buy it. So it was very illiquid at the time. But it was a great time to get in. It was a great time to learn the business. And I invested in mobile home parks and self-storage for my own account, essentially, before I launched Crystalview Capital Fund 1, which was back in 2014. And I took, all the strategies I learned, and I just applied them to the fund concept, scaled it up, and thought, this could be a pretty good business, and it turned out well.
Nice. So you said is the majority of your assets, you said is mobile home parks right now?
Mobile home parks and storage.
Okay.
The exact allocation, I'm not sure. In our fourth fund, we have more mobile home parks than self-storage facilities.
Mm-hmm.
But we've probably got 250 to 300 million in both, somewhere in that range.
Wow. How many pads does that equal out to? Or
we've got, I think we have about 6,300 pads.
Wow, nice.
Scattered throughout the country, and we've got 23,000 self-storage units.
Wow.
So
Jeez.
collectively, we've got about 30,000 units that we're managing.
Okay. I know we're a mobile home park show, but what do you prefer, mobile home parks or self-storage?
Well, I get that question all the time. It's a great question. I think they both provide benefits that the other doesn't. And that's why we've devised our funds through a commingled strategy of both mobile home parks and self-storage. We call it the best of both worlds.
Mm-hmm.
The self-storage, in my experience, delivers higher free cash flow because there's lower CapEx, there's lower operating expenses. The mobile home parks, you're creating more value by bringing in homes. Your rent increases go a lot further, but it requires more capital and it's more management intensive. But I think when you blend them both together, we call it the best of both worlds.
Yeah, nice. Have you started looking at any other asset classes besides those two? Have you looked at like RV parks or industrial?
We have, kind of offshoots to storage, which is kind of small bay incubator space for contractors.
Okay. Yep.
And then on the manufactured housing side, we do have RV parks. That is probably a low percentage of what we own. Our bread and butter is just your pure play MH and self-storage facility.
Nice.
One super impressed, the fact that you have over $100 million worth of properties and mostly mobile home parks in the pipeline for the next 120 days. How do you what is your acquisition strategy that allows that type of scale? That is incredible. Like we hunted for years to find our right deal, like probably a year and a half before we closed on our first one. And now we're gaining a little momentum, but what you're talking about is incredible.
Yeah.
Level.
Yeah, I appreciate that. So first off, probably about $37 million of that number is under contract. The balance, we're actively negotiating PSAs or we're in late stage negotiation. So they're not all under contract. But the way we do it, I'll tell you, it's an interesting approach. We source most of our deals off market. So as opposed to working with we work with a lot of brokers, but participating in auctions and competing against some of the institutional players, very difficult. Their cost of capital is a lot cheaper than ours. So what we've done is it's really a relationship game. We try to find out what's most important to these sellers. Sometimes it's handing down a legacy. Sometimes they just want to be proud of the park when they drive by it. It's not always the buyer who's going to pay them the most amount of money. And a lot of these owners, I'll be quite frank with you, they're turned off by, let's call it your Wall Street operator, who's just a capital allocator. They don't operate. They really don't know the business that well. They're good at allocating capital, and they're looking to aggregate. You know, we're hands-on. We're an owner operator, and we're out there actively on the phone. We're in the air, going and meeting with these owner operators on a daily basis. We have a sales team of 8 full-time professionals, and they're just building these relationships, putting offers out there, finding out how we could help, structuring win-win deals. And that's how we've been able to build up this pipeline of 100 million.
Nice.
That's 8. Are these local people, 8 local acquisition specialists? So not overseas, nobody in the Philippines or in Latin America doing these calls for you?
No, nothing against overseas. I just feel like that to build that rapport and that trust, you've really got to be there. You've really got to understand it. So our salespeople, they understand the business. It's not just, hey, do you want to sell? Do you want to sell? Do you want to sell? They're building the relationship because they understand how to operate. And that really creates that bond and that relationship. And then I go out there and I meet with these folks. You know, I'm out on the road a couple days a week, usually touring assets. And it's all about relationships at the end of the day.
Nice. And you're based out of Las Vegas, is that right?
We are. Yeah.
Nice. You got the A's and the Raiders, and everybody's going to Vegas now.
Yeah. No, it's really incredible what's happened locally with sports. So it's great to see.
Yeah, nice. So I want to go back going back to the underperforming assets, like if it's low rents, with your guys' management company and that many pads under management.
Yeah.
When you find a park that is, let's say, half the amount below market value, and say it's a 100-pad park, how are you strategically going through and increasing those rents without having such a huge vacancy or people moving out?
Yeah. So it's an interesting business. I'll say, you know, to move a home out of a community into a competing community, it's typically going to cost you, and it's going to depend on the geography, but it's typically going to cost anywhere from $6,000 to $10,000. So if you're competitive in your rents, despite a rent increase, you know, most logical tenants aren't going to move from your community to go down the street and pay more, and in some cases into an inferior park. So I think the first step there is you got to really understand the marketplace and where those market rents are. And we like to fall right in line or a little bit below, because I think that creates a compelling story for folks not to leave. And, you know, in my career, I know it sounds crazy, but I can't think of any that have left our community for that reason. Now, they might be moving to a different city. That's a different story, but just, hey, your rents went up too high and I'm going to move down the street. Believe it or not, over the 20 years I've been doing this, I don't think that's ever happened to my knowledge.
Yeah, that's another reason why mobile home parks are, I like them better than RV park, because even if you have a community type RV park, long-term residents, you do raise it too much, they could just take off on you.
That's right. They're very mobile. They could drive away. In this case, they can't. And I think the other thing there is you got to create that bond and that relationship with your residents and show them you care. You know, hold community events, invest money back into the community. You know, unfortunately, and I'm sure you guys are aware of this, there are some, you know, bad owner operators. I won't name names, but rents just go up and no investment goes back into the community. And then kind of we all get a black eye. But
Yeah.
there's so many great operators. The great operators far outweigh those bad actors. But you just have to be conscious not to be doing that. And it comes back to community involvement, having a great on-site manager, having a great asset management team overseeing your on-site manager.
Yeah, definitely.
Can you talk a little bit about some of, I know you did briefly there, what does it take to create that community? Are there like keys that you guys, okay, these are the things that we need to implement in our park to create that look and feel and to create a community within the
Yeah.
park?
Yeah, there's a number of things that could be done, Ben. I mean, it could be as simple as, hey, we're going to have a cleanup day on the second Tuesday in spring and kind of get all your trash out of there. And then from there, we're going to give 1 month free lot rent to the nicest yard. And you kind of create some friendly competition and camaraderie where they want to invest back into their home and have a respectable yard, a respectable home, something that they're proud of. It's all about building pride of ownership, and we put money back into the roads. We try to help and educate them on how to clean up their lots. We enforce rules and regulations to make sure there's not a bunch of trash out there. We try to help them and educate them on putting heat tape on their pipes so their pipes don't burst in the winter in the northern exposures. If they don't have skirting, we could help them in that process of getting skirting on their home. So there's a number of different things that don't sound like much, but they go a long way and they kind of create that morale, if you will, within the community and the residents.
Nice.
And then to kind of follow up on that, park-owned homes versus tenant-owned homes, and your opinion on that. And is there a way to create that same feel in a park-owned home community?
In my opinion, I definitely prefer tenant-owned homes. I'll just start there. When we buy new communities from some of these owner-operators, a lot of them we inherit these park-owned homes. We look to transition away from a park-owned home to a tenant-owned home. So we've got rent-to-own programs, we've got sales programs, and we educate them and show them that, hey, this is an opportunity for you to own a home. At one point you could sell and you're going to be building equity. So that comes back to the education and the sales process. But by far, in my opinion, you're really going to have a nicer community when your concentration of park-owned homes is a lot lower.
Yeah.
So in regards to the POH to TOH, when you're dealing with a seller and they have a good mix or a high percentage of POH, how are you handling that negotiations? Because obviously the value is not really there, but there is some value in collecting a higher rent. So how are
Sure.
you handling those negotiations?
Yeah, I mean, there's comes back to the education and the sales process, even with the seller. The first thing is, I think a huge mistake for somebody who's underwriting a MH deal is to bake in that park-owned home income into your revenue and it falls into your NOI because no bank and no buyer is going to underwrite that income. So you've really got to strip that income out and pay a wholesale price for the home. That's typically how we do it. And you're just underwriting lot rent. And a lot of that park-owned home income gets chewed up through repair and maintenance. You got to remember, one of the compelling things about this asset class is very low turnover, very low R&M. And the reason for that is we don't fix toilets, we don't fix roofs, we don't fix sinks because it's their home. However, when they're park-owned homes, you're kind of in the apartment business, just with a mobile home. So you've got to have the staff and the crew that's going to work on that repair and maintenance on those homes, which is going to be pretty burdensome on the expense side.
Yep, definitely. So it comes down to educating the sellers of why you're coming up with that value, because the banks aren't going to be looking at that POH income.
That's right. And a lot of them, they do know that. Some don't. But I continue to be amazed. A lot of these smaller operators, they're just looking at cash flow and they're not looking at NOI. And NOI is really creating value. So for us, we kind of eliminate that POH income and bring it all into lot rent. So I'll give you an example. We're actually looking at a park right now that kind of fits this mold. The lot rents are very low, but the all-in rent to own is probably at a market level. So we're going to come in and restructure and sell those homes. We're going to bring the lot rent up, which is like another $150 a month. We're going to bring the POH rent to own income down because there's really no value attached to it. And we're going to create a couple $1 million of value just through restructuring of leases and rent to own agreements.
Yeah.
So there's things like that that can be done as a value add as well, which is kind of interesting.
Yeah, the RTO side is an interesting side of things too, which we're seeing more of those in parks. But the problem with that too is, are you seeing difficulty with the banks counting that income from an RTO? Say it's a 10-year note.
Yeah, the banks aren't going to count that. You
Yeah.
know, when you go to the agencies, even when you go to a local bank, they're just going to be underwriting that lot rent. So if you've got income coming in on the finance side or on the RTO side, you're not really getting credit for it.
Yep.
One of the interesting things we've done is we've started a lending company, and we're licensed, and we're actually offering financing to some of these residents, because that's the other thing that's very difficult. They're not able to go out there to their local bank and really get debt to buy these homes. So the default rate is a lot lower than you would think. So we're actually extending some pretty attractive terms to these folks, which is allowing them to own a home. And in the process, we're eliminating that POH income.
Yeah. Nice.
What kind of terms are we talking here that you're able to offer them?
Yeah, you know, it's going to depend on the credit worthiness of that particular resident, but let's just say, you know, 8 to 11.5%,
Wow.
you know,
Yeah.
with a 10, 15, 20% down, which, you know, there really is no market for that. So for us on the lending side, it's a pretty attractive yield, but it's a win-win because on the resident side, they're building up equity in their home, you know, and they couldn't get those terms really anywhere else.
Yeah. Nice.
Some other people we talked to, as far as the 10 to 15% down, oftentimes they said that their market can't support that type of down payment. So they're just happy to take $1,000 just to kind of get that home off their books and create the tenant TOH rent.
Sure.
Is that something that you do as well? Depending, is it a market by market?
Yeah, you know, I think it comes down to the quality of the home and what kind of, to your point, what kind of market you're in. You know, if you're in a strong market and you got a decent home, I certainly wouldn't give it away. I would figure out a way to sell it, because that is going to generate capital. You could reinvest and buy new, you know, more homes and fill more vacant sites. But if you've got really old homes and it's not the best of markets, we have done that in the past. We try to stay out of those markets. We want to be in great resale markets. And that's part of your underwriting when you're looking at a deal.
Yep. And these parks that you currently have under contract, are you seeking out traditional financing on these, or are you doing seller financing on it right now?
So the majority of them, we pay cash.
Okay.
And I will say we pay cash, or we have a revolving line of credit. So in our fourth fund, we have a $50 million revolver. In our third fund, which we're still acquiring assets in, we have a $75 million revolving line of credit. So what we're doing is it's acting like a bridge facility for us. So we're taking down the property in that bridge facility. We're executing the business plan of creating value. Once we, stabilize the asset, we go back to typically Fannie and Freddie, and you put long-term fixed rate debt, replenish your line, and rinse and repeat the process again.
I see. How long are you projecting out to complete the process of getting the value add, basically?
Yeah, you know, every deal is a little bit different. We've got a deal in our fund 4. You know, it appraised for like 40% more than what we paid for it in like 6 months.
Nice.
So we're actually in the process of putting new debt on that right now, and we're able to pull all of our equity out of that deal, which is fantastic.
Yeah, that's great.
yeah, and then we could go out and try to do that again. They're all not that good, but you know, sometimes again, a function of bringing some homes in and increasing occupancy. Sometimes it's you've got water and sewer expense that's trapped at the ownership level that we could pass through, and that's all going to fall to the bottom line. Sometimes it's the rents are materially below market, or it could be a combination of all of the above. Each deal is different, but on average, I would say to really stabilize, and there's more value add upon stabilization, but to really get it in a place where we want to put agency debt, it's anywhere from 12 to 24 months.
Nice. Yeah, that's a good turnaround, and that's good to hear. Are you in? You guys are looking at stuff where you need infill and rehab also?
Oh yeah, yeah.
Yeah.
So we're buying some communities that have vacant homes in them even.
Hmm.
So we go in, we actually have a mobile crew at the corporate level.
Yeah.
Because what we found is when you engage these third parties, it's very challenging. And a lot of them don't have experience working on mobile homes. So we've got a trained crew that kind of goes around the country, and they're working on these homes, and they'll come in, they'll knock 5 homes out, they'll go to another community, knock 3 homes out, just keep rotating like that. And that really allows us to fill vacant sites a lot quicker if we didn't have this crew.
Nice. That's
Amazing.
a good setup.
What, when you started buying mobile homes, it sounded like you went from buying them from yourself and going directly into creating a fund. Was
Yeah.
there a point where you started like, let's just syndicate a deal or two? Because even from talking with others and knowing friends with funds, it's scary, at least from my perspective right now, when we sit having a fund where you have all these obligations to these people and this money and everything around it, and to make sure that you can keep it coming in. What gave you the confidence to go from deal to deal to raising a fund?
I think a lot of it was we had unmatched deal flow then. I feel like we've got better deal flow than any operator, any sponsor out there because of the things that I've mentioned with that building of relationships and just putting in the work, rolling up your sleeves and putting in the work. So we've always been able to deploy capital as we've raised it. I think that's certainly a concern of sponsors in the fund space, that they're going to go out there, they're going to raise equity, and they can't find good opportunities to deploy that equity into. I think it's just a matter of preference. I mean, for us, we like the idea of having the capital up front, not going back to investors and having to sell them on every deal like you would in a syndication. We like the idea of selling them on us up front, our track record. And frankly, with our track record, that sell is a lot easier than it was 10 years ago. We could back up some returns in our first fund, as an example, has gone full cycle, and we had a gross level IRR of 46%. We're tracking to the 30s in our fund 2, high 20s in our fund 3, and fund 4 is just going off really well. We're already hitting an 8% preferred return in that fund to our investors.
Nice.
So I was confident because of our management team, and our ability to bring in great opportunities and our ability to raise capital. So that structure, not that one's better than the other, it's just personality-wise, it worked better for me. And that's why I've decided to stick in that concept. And I'll tell you, I invest a lot of my own capital into the fund as an LP. So there's a really strong alignment of interest between me and my partners. And the reason I do it is twofold. One, I want that strong bond. I want that strong alignment of interest. But to hit a mid-20s level return, I don't know where I could get a better risk-adjusted return. So I do it for that reason as well, which is, I guess you could say, is selfish, but nobody complains,
Yeah.
Yeah, no one will complain about the operator putting money into the deal, showing confidence that
Never.
money in your mouth is.
So we kind of roll our fees and our carry right back in and buy more units because, the reasons I mentioned.
Yeah. So to be raising that much capital, you must have what's that team look like that's just constantly raising capital?
Yeah, so we've got, we just brought on somebody new. His name is Ben Brundage. He's the director of capital raising at Crystalview. And he does a fantastic job. But basically the process is going on road shows, going to conferences, creating a sales funnel that brings in, people that are interested in both asset classes and they're looking for a best in class sponsor. A lot of our investors are fund of funds. So what they're doing is they're going out, they're a fund themselves, they're raising equity, but they're capital allocators. They're not operators like us. So they're looking for best in class sponsors to allocate to. So a lot of our equity comes through that channel. And right now, family offices is another big one for us. We're actually exploring the broker dealer channel as well.
Okay, nice.
What is that?
So a broker dealer is, think of like, a private wealth fund, a private wealth company, maybe like a Raymond James, something like that. And what they do is they're kind of vetting and underwriting potential investment opportunities for their clients in the alternative world. And they'll find an operator like Crystalview and say, hey, I found one. These are people that aren't going to do the research and find, like an MH or a storage fund. They're probably more your doctors of the world. They're your professionals that are high income earners that basically go to one of these wealth advisory companies and say, hey, you do this for me. But the fees are quite high. That's the trade-off. So, a lot of our investors, they've done the research. They've found us because they've been looking for a best-in-class sponsor.
Nice. Yeah, I mean, you got some impressive numbers. You've been in it for a long time. I mean, it's just it seems like a great benefit to any of your LPs that would be coming in working with you guys. Nice.
Yeah.
Well, so what has been from the starting 20 years ago to now, what has been the biggest challenges you're seeing with this new kind of era of purchasing in mobile home parks?
Yeah, there's a lot of competition. However, I'm not complaining. I still think we're nimble enough to find great value for our investors, and we've proven that. Probably the largest challenge is finding great talent, to be completely upfront and honest with you. It's not so much the deals for us. It's not so much the capital. It's finding the talent that's motivated, that's going to fit in the culture, that's like-minded, that wants to work with us on a daily basis to run the assets. I mean, we're an organization where it's a meritocracy and it's a roll up your sleeves and work hard environment. So we kind of lack hierarchy. We don't really have like, hey, I'm your boss, you're my subordinate, you're side by side to me. We don't think about it like that. We think about it like we've got a common goal and a common objective, and we're going to work like hell as a team to hit that goal and objective. And a lot of people, especially that came from the corporate world, they have a hard time with that philosophy.
Yeah.
So that's a challenge that we have for sure. But when you find those great people, I mean, they're absolute game changers.
For running such an organization with so many moving parts, and it sounds like you guys have an incredible team, have you focused your efforts on leadership or organization? Have you had somebody help you with this type of organization to kind of put the right people in the right places or support you in that effort?
No, we've never hired like a consulting firm or anything like that. I've kind of worked off instincts, to find great people. And sometimes you came across them doing a deal. Like you find a broker that's fantastic, that's trustworthy, that does what he says he's going to do. We've brought them into the organization. You always have to have your eyes open because you never know where you're going to find great talent,
Yeah.
Yeah. So what would you say has been one of the biggest horror stories of owning any of these parks you've owned? What's something that stands out to you?
I don't care what investment you make, there's always an inherent risk. And if you ever hear like, oh, there's no risk, then run. I'm here with you today and I'm saying on a risk adjusted basis, I love these asset classes personally better than anything else. Mm-hmm. With that being said, horror stories happen. Storage facilities burn down. Mobile home parks have tornadoes that go through them and rip out half your rent roll. Both of those things have happened to us. And guess what? they're going to happen in the future as well.
Yep.
If you're so risk averse that you can't fathom any of these things happening, or you're not going to be able to bounce back, then you should probably either be passive or find another industry to invest in. Because if you scale and you build a team and you're a sponsor, inevitably you're going to have some issues that occur at your assets. And that comes again why I like the fund concept. If you're in a syndication and that one deal doesn't work out, you don't have anything to fall back on. We could have one or two deals that don't work out well for us, and we more than make that up with all the winners that have exceeded our projections. And that's what we've done historically.
Yeah. The way you put it that way with the fund, I think it makes complete sense. You know, it's you're spreading the risk over multiple assets, which is a smart way of doing it. Because you said syndication, that one project could go bad, and there's nothing to fall back on.
That's right.
And that was that the main. I know you kind of mentioned it before. That was one of the main decisions of why to go that.
I think that was part of it. The other part is, again, I liked having the autonomy, and I liked having the capital up front that I could go and be creative with and put great deals together, rather than I would hate to be in a position where I get left at the altar. You know what I mean? You've got this great deal, you're out there, you're trying to sell it, and an investor doesn't see value the way that I do or you do, and you're not able to do the deal because of that. And for that reason, I always like the idea of raising the capital up front and not having to ask what I'm going to invest in. And I think that, again, it comes back to a great track record. If I start investing in deals and they're not doing well, I'm going to have a real hard time raising capital in the future.
Yeah.
So I need to deliver outsized returns, but I'm more than up for the challenge.
Yeah, your perspective on the fund is awesome, because I think you're the first person that we've had on the show who's given us really the benefits of a fund and that model, if you can support it. Do you actually, if there's a listener and they love what they're hearing, one, are they able to invest in one of your funds, and is there a threshold? And then I guess the follow-up question, for a funds of funds, which we've talked to and dealt with before, they usually want some points of the GP. Is that something that you deal with, or how do you structure with the fund of funds as well?
Yeah, so first off, we have an active fund that's open right now. It's Crystalview Capital Fund 4. If anybody wanted to reach out and learn more, you could send an inquiry to invest@crystalviewcapital.com. In terms of fund of funds asking for a GP stake in our GP, that we have not been asked that. And if we have, we wouldn't grant it anyway. I think what's happening there is it's probably less experienced sponsors who are just starting up, who are willing to do just about anything to bring capital in. But when you've got a track record of returns, and you've got a robust pipeline, and you've got a management team, and you've got scale, in my opinion, there's no reason to give up a piece of your GP.
So with the fund of funds that come to you guys, you're just offering points of some sort, and that's it?
It's not really points. We have a structure where essentially it's a tiered investment class. So the minimum investment is $50,000. So class D is $50,000 to $500,000, and they get a 7 pref and a 60-40 split. And then we have a class C, which is 500,000 to $1 million, and they get 7% pref and a 70-30 split. And by the way, I could send you guys the deck. We'll have all of this.
Okay.
And then we have a class B, which is a $1 million investment to a $10 million investment. They get an 8% pref and an 80-20 split. And then the final class is A, which is a $10 million plus investment, which a few fund of funds do have with us. They get a 9% pref and they get an 80-20 split. So the incentive there is they're getting a higher pref that they're able to pass through to their investors. But we're not really paying them points. First off,
got it.
You have to be a licensed broker dealer to compensate somebody for bringing capital in. And a lot of them are not. They're just sponsors themselves that charge fees and carry to their clients.
Got it. Yep. So then okay. So no equity in a deal on the GP side. You guys have your tiers, and then they're going back to their investors at whatever rate they're promising, and they're collecting a fee from whatever on
That's
that
right.
side. Yeah. Got it.
Yeah, they have their own internal preps and splits. A lot of times we don't know what they are.
Yeah.
But they're getting a carry based off the distributions that we're making, I'm sure, within their waterfall. But I don't really get involved in what that is.
Yep.
They're just investing on terms that are consistent with our PPM. We're not giving them any special treatment.
Yeah. Nice. That's a great way to set it up. Plus you have the track record to be able to do that, right?
Yeah, that's right.
Yeah, it's
Oh.
amazing for the fund of funds too, because if they're raising the 10 million plus, they could offer the 7 or 8 pref
Right.
and then 70-30 instead of an 80-20, and they'll make plenty of money themselves too with that
Sure.
spread. Well, that's great.
Absolutely. And I know some of them do that.
That's
Yeah.
awesome.
Yeah. So I know you mentioned briefly how people can get in touch with you. You talked about you still have a open fund right now. It's invest at Crystalview is how people can get in touch with you in that fund.
Yeah, invest at crystalviewcapital.com.
Okay. We'll make sure we put that in the show notes and throw it up there.
Or visit our website at www.crystalviewcapital.com. There's a whole intake form. Ben's information will be listed on there. You could reach out direct. You want to see a deck, you want to see our PPM. If you have any specific questions, we're happy to help in any way we can.
So I want to talk a little bit more about your team. With that many deals you guys are looking at, which is a very impressive. How many underwriters or who's doing the underwriting of the deals?
Yeah, so we've got a team of 4 professionals that are analysts at our company. So what we've done is we've created some proprietary software to basically plug rent rolls in, to plug some basic assumptions in under rate increases, occupancy gains, what expense loads are. You'll plug in an assumption on an exit cap over a 5 to 10 year hold. You'll put in some basic debt assumptions, the cost of capital for our revolver.
Mm-hmm.
And then from there, it's essentially going to extrapolate and spit out, what the IRRs are, what the multiples are, where the cap rate's growing to, cash on cash returns. So we're evaluating deals based off several different metrics. And those deals that work, we go to investment committee. We have kind of like this back and forth banter. Our analysts, our asset managers, myself, our CFO, we talk about what we like, what we dislike about the deal. It's really a cool environment, and it's open. And we call it an idea meritocracy. We encourage people to bring your ideas to the table. I don't want to come into that meeting and just, be a preacher there. I want to know what you think.
Yeah.
So we encourage that type of behavior. It helps us nix deals or say, hey, this is a great opportunity. We didn't see that value there that somebody else saw. So again, it comes back to the value of the team. Once it passes investment committee, we'll typically take that deal down. We'll set up the financing. We'll set up the legal structure. We have an acquisitions team that's working with the title companies and with our counsel to look at title policies and order third-party reports, environmental, phase 1, alpha survey, all that good stuff. And then once all those boxes are checked, we'll go ahead and buy the deal. And then it's basically packaged in a nice bow with an investment memo, handed off to the asset management team, and it's time to go and execute on that value creation plan.
Nice. How big is your guys' team right now? How many employees do you have?
So we have about 56 at the corporate level.
Wow.
We've got probably another 130, 135. So across the company, we have close to 200 employees right now.
Wow. Impressive. That's
yeah.
And what's your day-to-day look like within the company right now?
So right now, my day-to-day is, I try to be inspirational. I try to be a leader to everybody on the team. I show up every day. I'm here 8, 9 hours a day. So I know a lot of some of our peers and competitors, they don't do business the way I do. Not knocking them.
Mhm.
It's just a matter of preference. I feel like if I'm not down in the trenches with my team, I don't know if they could ever respect me the same way as if I were. And that's why I show up. And honestly, I love what I do. And I
Yeah.
can't think of doing anything else that would be more fun than building a team, building that camaraderie and that environment where you could scale and do things that nobody else could do.
Yeah.
So my time is spent, on the higher level, bringing in new talent. We're having some calls with COOs today who are applying for that position. My time is spent communicating with the rest of the team members, whether it's on a potential acquisition, whether it's on a value creation initiative within assets that we already own, signing a new lease, bringing in more homes, overseeing that process, having final sign off, working with our accounting department on budgets and P&Ls to ensure that our properties are hitting the budgets that we set for them.
Nice.
And then I'm provided, these KPIs on across the entire portfolio. And then I'm communicating with the director of operations of why aren't we where we need to be, or this property is doing even better. I'm interested to know why, in case we could apply that at some other asset. So it's a number of different things, but no 2 days are the same. Sometimes something crazy hits you out of left field. But it's a hard day. We all put in a hard day's work. We usually get out of here about 5 or 6, and I'm in here by 8 a.m. every day.
Nice. Yeah, I love what you said, that you're in the trenches, right? You're not just the boss, you're a leader basically, because you're in there doing the work too, and your team is seeing that, so that's got to add better morale throughout the company. I would think.
Absolutely. I think it has a more profound impact than just kind of sitting at a desk and barking orders and being on vacation half the time.
Yeah, yeah.
It's probably responsible for why you're growing at the pace you're growing and able to maintain it and even increase your momentum, which is incredible. Yeah, I don't want to say unheard of, but you're in the top of the top percentile for running an
Yeah.
organization, which is awesome.
Well, I appreciate that. And the only way I know how to, maybe I'm old fashioned. The only way I know how to do that is to show up every day and grind it out.
Yeah.
Give it your all every single day. Anything less to me is unacceptable.
Well, Matthew, we're approaching about an hour here, and so we do want to respect your time. But is there anything else that you would like to say to the listeners before we jump off?
Well, first off, I appreciate you both having me on the show today,
Yeah.
Dustin and Ben. It was a pleasure being here. But I think what I would say is, if this is something you've been thinking about and this is a dream of yours or a goal, just go out and do it. Sometimes people wait until they have everything lined up perfectly. They've got their perfect business plan. I never did things like that. I always said, let's just get out there and make stuff happen, and then we could adjust and adapt. So if you're thinking about getting into the mobile home game, it's a great business, but you got to be prepared to work. You got to be prepared to show up and give it your all. But don't wait. If this is something that you're passionate about, get started today and reach out to others that have done it. Find mentors in the industry. I mean, we're happy to help. We're happy to answer questions for somebody who's just starting in this industry. And hopefully they don't have to go through some of the bumps and bruises I went through. I could answer a question in 30 seconds to save them years of agony. So find people that have done it. You'd be surprised the amount of people that want to give their time and help somebody who's really passionate to make them more successful. I certainly do. And I had a lot of mentors when I started who took time for me and that helped me. And now it's time for me to pay it forward.
Yeah. Yeah. That's one thing we found getting into the mobile park space is everybody's been pretty open to sharing their experience and knowledge and helping and giving a lending hand when we have questions. So it's been awesome.
Yeah. Agreed. It's a great industry.
Yep. Well, Matthew, appreciate your time again. So much knowledge and gems that you dropped in this podcast or show. So we do appreciate you coming on and taking your time out of your day.
It was fun. Let's do it again soon.
Yeah. Thank you, Matthew. Appreciate it.
Thank you, guys.